Hello everyone, welcome back. My name is Greg Furman, and this is the Forex Weekly Outlook for the week of August the 1st, 2016. Now, to get started this week, we're going to mix things up a little bit. We're going to be looking at direct intermarket correlations on four of the main currency pairs, in my respectful opinion, which would be Euro-US, Great Britain-US, US-Japan, and we'll look at US CAD maybe, for example, as main intermarket correlations. Now, when we're looking at Forex, we're predominantly trading, buying or selling US dollars. That's the main thing here. So when we look at trading Forex, we must be looking at the dollar index. Now, this is the DXY, very, very important indicator here. We can see we have a massive trend line that's formed up here just under this 98 level. Now, again, this is a very, very significant level. Now, I'm going to just draw everybody up here. We're going to see how we draw our trend lines here. We're connecting this basically to our high point here, and then we go back from right to left, never from left to right doing our trend lines, and we come back to the February high. So we haven't been able to break through this swing high back in February here, and we've since then sold off. Now, two reasons for the dollar sell-off here this past week: the Bank of Japan's lack of action on the monetary easing front, not cutting rates any further, and number two, to some degree, an overreaction to the US GDP. We can see that the bulk of the losses on the dollar were actually on Friday's bar, so everybody can see this, and prior to that it was struggling but still doing okay. So its main thing to understand is I believe that the market is to some degree overreacted. Now, our key VantagePoint 18-day predicted EMA, we'll just go back here so everybody can see this, comes in at 96.55. We can see that we've closed at 95.49, significantly lower after that GDP number. Now, once again, guys, GDP is not normally a big market maker. We know that there's very little growth globally, not just in the US. But the case for the dollar that I'll make here, which everybody should think about, is the fact that in reality of the G10 countries, the FOMC is the most hawkish of the central banks. So we really do want to keep that in mind. So I don't anticipate the dollar will move lower for very long here, is long and short of what I'm saying. So we'll look for those indicators from VantagePoint to turn around, but right now they're accurately predicting that essentially the dollar's been going lower for the last 3 or 4 days. So we'll keep an eye on this very closely. We could be coming down potentially a little bit lower down into these former swing lows down around this 93 area, but we would be a buyer of dollars down in that area to clearly understand. Now, what I'm going to do here, just to mix this up, what I like to do is show direct intermarket correlations. So when we're looking at the intermarket correlations that drive the US dollar, that's something that we want to just stop and take a little closer look at direct correlations. Now, once again, for the savvy trader that knows these intermarket correlations, they could be much like myself, where I could be trading the Forex market like Euro-US, and I'm not even looking necessarily at the Euro-US chart. I'm looking at the dollar index chart. If I'm trading equities, I may not even be looking at the S&P 500. I could be looking at my signal from the dollar. So when we look at these intermarket correlations, very, very important, guys, that we understand what they are. So to start with, on a main driver of the dollar, we can assess that the dollar likes it when the equity markets go up. Now, from 2008 through to about 2012, this was an inverse correlation, but that's not what it's been as of late. We can see that basically, the dollar can be a leading indicator for the equity markets. So if we have a crossover to the downside on the dollar index, that suggests that the S&P could struggle this week. Looking at the, sometimes we get a slight delay. Sometimes the correlation's not 100%, but right now it's about 85. So about an 85% correlation would tell me that if the dollar is going lower, that's going to pull some of the global equity markets down with it. First of all, potentially being the S&P 500. Now, case in point here also, that's been a very, very interesting correlation here is the DAX 30. We can see as the DAX 30 goes up, that indirectly puts upward pressure on the dollar index. That actually helps the dollar. So once again, we can see this correlation all through these charts right here. So as the DAX took a nice big move to the upside, that caused the euro to sell off here, guys. That's what actually happened. We can see the dollar index wasn't super strong, but it was strong enough, to keep it moving up. So once again, if we see that the dollar index is going lower, that would tell me that the DAX potentially is getting ready to turn around also. Now, one of my favorite intermarket correlations with the Japanese yen is the Nikkei 225. So this correlation is very, very high here, guys. Now, this is just over a 3-month period. We can see that as the Nikkei goes up, the dollar index goes up. So this is an indirect correlation to the US-Japan currency pair. So as long as the Nikkei is going higher, basically the dollar index is going higher. When one goes lower, you can see here basically they both go lower. So right now, you can see that the Nikkei was a leading indicator for basically the Japanese yen strength. If the Nikkei is going lower, then basically the yen is going to strengthen across the board. That means against the dollar, against the Aussie, against the CAD, the pound, right across the board. So when we understand these intermarket correlations, we can trade them. So we see the same thing for the CAC 40. Now with the dollar index right now, you can see that it actually has a very to some degree it has about a 70% positive correlation to oil. Oil goes up, the dollar tends to go up. So we can see as oil's being pressured to the downside, the dollar index pauses. So these types of correlations, RBOB gasoline contracts, we want to look at them very closely. Now, also with your gold traders here, so you can see that I'm covering Forex traders here, I'm covering commodities, and I'm covering global equities. So when we look at this right now, with the gold moving higher, that tells me that probably the equities again are going to be getting ready to move lower. The dollar index immediately reacting. Now the correlation to the dollar index and gold is again, nothing's 100%. We can see here, but it's very, very high, guys. So basically one goes up, we've got gold going up, then we have the dollar index going down. That would indirectly fuel strength in currencies like the yen, like the euro, the Swiss franc. So these are the kind of things that we want to know and understand in our trading to really capitalize on some of these Forex moves. So basically coming back to our main charts here, by breaking this down and understanding these intermarket correlation that, if the dollar index moves, or if the S&P 500 moves, or the Nikkei moves, it can spin off in multiple Forex trades, commodities trades, and again, equity trades. So there's a lot going on here, guys, a lot. So right now we've got these global equities markets. The S&P 500 continues to push higher. The level we need to watch this week is 2144. If we can hold, I believe 2144 is going to come under pressure at the beginning of the week because of its correlation to the US dollar index. We've also got the global indices moving lower. The Nikkei is pushed below the key VantagePoint 18-day predicted EMA. I'm just going to drag this over so everybody can see this. And once again, pushing below that 16,421 mark suggests further yen strength. Okay, so that indirectly basically produces dollar weakness. This is what happens. Oil still moving lower. So when we go into our direct Forex pairs, and again, gold, we still have gold trying to push higher, but it got a bit of a boost on Friday from that GDP number. I'm not sure that gold will be able to hold those gains. But when we look at these intermarket correlations directly or indirectly, we need to understand how all this works. So we've got a couple of major pairs here in the Forex, in my opinion. Euro US, British pound, US Japan. These are three major currency pairs that drive all the cross pairs and everything else. Of course, we've got the CAD, the Aussie, the New Zealand. They're smaller ones. The Swiss franc, well, it's pretty correlated to the euro. So these are the ones we've got to watch. Now, for next week's trading on the euro, we can see that again, we've got the euro, we've got a triple EMA cross from VantagePoint. We're holding above 110.62, closing at 111.72, but we are largely just range trading here, guys. That's all we're doing. Is that going to be enough to push the euro higher? It's possible. With this fresh triple EMA cross, our indicators here are all pointing higher. Our neural index, our predicted short, medium, and long-term differences, all looking good. Our predicted MACD crossing the trigger. 72.4 on the predicted RSI. Not bad here, guys, but again, the euro, when we look much closer at this, the bulk of the gains have been made off that poor GDP number. So my optimism for excessive gains in the euro remains heavily guarded here. I think we are still range bound. For me, I want to see a break of this bar right here, which is 114. That would take the downside pressure off of the euro for the remainder of the year, but we must break through this 114 swing high here where we were just prior to the Brexit. Right now, all we're doing is making up lost ground here, guys, from where we were to that Brexit vote. So that you can see we've got our high point, our low point. So we're actually holding down along this swing low from the Brexit vote. That trend line coming in, which I talked about in last week's weekly outlook, about 109.50. I suggested potentially small longs here may work, which they in turn did. But again, we are still range trading. The big obstacle we've got to break right now here, guys, is 112. That's what will trigger a bigger rally, but be careful of a bull trap up here. I have seen this time and time again. We want to be very, very cautious. Now, the predicted MACD still below the zero line, just to bring that up. That's very important. So when I'm looking at some of my direct intermarket correlations, people will often say to me, well, how do you know when to trade the euro? What exactly are you looking for in trading the euro currency? So let's have a closer look at this, because the euro is arguably the most heavily traded, Euro-US is arguably, the most heavily traded Forex pair, but in my opinion, it's also pretty manipulated. So when I look at trading the euro currency, guys, what I'm looking for here, what we should be looking for here in general, is these intermarket correlations. So when I look at the DAX 30, let me just bring this up so everybody can see it. The DAX is a driving factor in my respectful opinion. So when we look at the DAX 30, we can see that as the DAX 30 moves higher, that pretty much immediately forces downward pressure here on the euro. So if this signal is actually correct on euro US, then that means the DAX 30 is getting ready to move lower. So this is a big player. We can see these correlations all over the place. So basically, if we have the DAX moving higher, or if the DAX is moving lower, then when the DAX moves lower, then usually the euro currency gains strength. So you can see here that as the DAX moved aggressively higher, that pinned the euro. It was simply unable to move. Now we can see right in this particular situation, when the DAX moved lower, the euro immediately rallied off of this right here. So this is what you want to look for here, guys. When you're trading the euro-US pair, you want to look at these intermarket correlations. Gold is a big factor for the euro currency. So again, case in point, when we look at these basic blue line crossing over the black line, for the most part, when gold goes higher, the euro goes higher. That's what we see. When gold goes lower, the euro-US pair goes lower. So the intermarket correlation here will trump all of your basic indicators, in my respectful opinion. Your Elliott wave, your Fibonacci, they can all be, an intermarket correlation will trump these every single time, guys. That's all I can tell you, or at least 85 to 90% of the time they will trump it. So when I look at the additional indicators that I'll watch for, of course the dollar index we can assess here. We've got 100% correlation here. As the dollar index started moving lower, the euro-US currency immediately started moving higher, with virtually zero lag here from the VantagePoint program telling us that this is coming. This is using the medium term crossover. I don't want to go too short term, and I don't want to go too long term. I like it I like it in the fuzzy middle here, right around that medium term crossover. So I can take a little bit of both sides of this, but predominantly that's what I'm looking for. The dollar index, it is a major player against the euro currency, and Euro Great Britain, of course, also is and I will point out here that Europe's biggest trading partner, or at least for now, depending on the Brexit, is Germany. So, basically this pair has a big influence on Euro US and Great Britain US. Very important that we can see these direct correlations. So those are the key things I would look at, the equities and the commodities when trading that euro currency. Now, when we look at its counterpart, which of course is US Swiss franc, this is 100% correlated to the dollar index. If the dollar index is going up, then US Swiss franc is going up. If the dollar index is going down, then the US Swiss franc is going down. Now, my concern with this again is an overreaction on thin illiquid markets in summer trade on a Friday. The GDP number was not great, but it wasn't that bad. And the central banks, the FOMC, is still the most hawkish out of the G10, bottom line. So when we look at this, let them push it a little bit lower, but watch for a long midweek here on US. Watch for a violent turnaround on this one. Now, we could come down to this most recent swing low. That's entirely possible, down around 95.50. I would look to be buying down around this area, start entering into small shorts here, and I'll be looking very closely for the VantagePoint indicators for that turning point. Now, case in point here also is, once again, once our RSI gets down into a more reasonable level, I'll be looking for an oversold condition. Now, when we see the last time that this happened, we can see it was down around this area right here. We went sideways. That would put the RSI at about 20. Well, actually about 18. So we're about 24. Excuse me. Let me just draw that in better so everybody can see it. We're at about 24.4. So once we get below 20 on the predicted RSI, basically, we're on alert here for a potential short trade, or a potential long trade. So I think we have a little bit more downside, but we definitely want to start considering long trades towards the latter part of the week. Wednesday, Thursday, I think longs will work quite well. Now, when we come into the British pound US, this is a very difficult one as of late because of the Brexit, but we're starting to basically come out of this. We've got a couple of swing lows. We have finally paused down here around the 127 area, but we need to clear this critical vantage point level, 132.43. We've closed 132.25. The British pound US dollar, now again, I promised everybody we're going to look at some direct intermarket correlations, so let's bring some of those levels up. Right now, the British pound US dollar is basically running somewhat flat, and I believe it can't break out to the upside, not because of fear of the Brexit, but because of weaker commodity prices, specifically light sweet crude oil. Now, you can see that this is an indisputable chart here when we look at this, and I don't hear a lot of other analysts talking about this, but essentially when oil goes up, we've usually got the British pound going up. We can see that it reacts to it. There's about an 85% correlation here. Once again, you can see that as oil tries to recover right here, the British pound does also. Then we get into our Brexit here. We try and get a crossover right here, small longs, but again, with oil prices moving lower, this is a big factor in my respectful opinion, what is causing the British pound weakness. Now, predominantly oil prices are pretty much peak out, in my opinion, at the end of September when summer driving season ends. So we want to look at this very closely. Now, the RBOB gasoline contracts, another huge intermarket correlation here for the British pound. When I look at these types of correlations, guys, this is how the better traders look at things and say, okay, well, just because a standard indicator says something's going higher, what else is it? That really what's pushing it higher? In my opinion, no. When we look at the gasoline contracts pushing higher, I believe that directly fuels the British pound. When we sell off on the RBOB gasoline contracts, you can see that RBOB immediately reacted to that also, sending this lower, and we have still not recovered. So in order for me to be aggressively buying the British pound US dollar, I want to see oil prices higher. I want to see gasoline contracts higher. We're not seeing that, guys. We're not seeing that at all. So for now, the British pound remains somewhat pinned to the downside. Now, is the GDP number enough? Is it going to be enough to lift the British pound? In my respectful opinion, I don't think so. Not at this particular time. Euro Great Britain, we can see that as Euro Great Britain goes higher, it's pretty easy to assess here that this major cross pair here, you can see on the Brexit vote, when the British pound tanked, it immediately took Euro Great Britain higher. So you can see, however, at the same time, when the Euro British pound started to show weakness, that's what fueled the rally in the British pound US dollars. So this is what I like to see everybody focus on. This is what I do with my own direct clients, is get them looking at these intermarket correlations. We're looking at oil, gasoline, the Euro British pound cross pair. These are what will make you guys money on a regular basis. Okay, when we look at the FTSE, once again, is money appears to be either going into the FTSE 100 or into the British pound. It doesn't tend to go back into both. So as the British pound starts to gain a little bit of strength, we can see that the FTSE immediately starts to go sideways. And of course, even the German index, the DAX. So predominantly, if the DAX is going higher, the British pound appears to be going higher. So these are the kind of things we look at. So again, if I see the DAX right here, I can just identify this right here on this move up. That actually gave a little bit of a rally. So remember about what I talked about with the euro, guys, that the euro does not like it when the equities are going higher. So Euro Great Britain sells off. That immediately puts a boost into the British pound US dollar. These are the kind of intermarket correlations you want to look to drive your positions. So we know that if that DAX keeps moving higher, then the probability is the British pound US dollar will keep moving higher. No guarantees. The intermarket correlations, they vary from time to time, but predominantly they hold over a very long extended period of time, sometimes months, sometimes years before those intermarkets change. So for the British pound, you can see we are pretty much dead flat. So if the British pound is going to recover, then essentially those global equity markets, the S&P, the DAX, they all need to keep moving higher, and they're not. So that would tell me we stay with the original plan, which is shorts. Now, with the dollar-yen pair, I had talked about this on several occasions with the Japanese yen, about this swing high and swing low. I'm just going to First of all, we're going to set this up so everybody can see our VantagePoint numbers. Then we're going to go in here and we're going to really look at this. So we've got a swing high here and a swing low here. That's after the Brexit. So prior to the Brexit, this is VantagePoint's forecast, and an excellent one. The dollar yen is going lower. VantagePoint forecasted this on May the 26th, and I was a huge advocate of buying the yen against the dollar because I believe that the Bank of Japan is going to make a mess of this. And sure enough, without fail, I can't count on too many things in life here, guys, but I can guarantee that most central bankers are repeated screw-ups. That's the nice way of saying it. And that they constantly interfere with the market, and it comes back to hurt them. So when they start to intervene against the yen, the market doesn't like that, and they immediately start buying Japanese yen even harder. And that's what they're doing again this week. Now, this is a twofold problem here. You've got the Bank of Japan refusing now to do any more easing, and you've got a weak GDP number on a Friday. Followed that up, next thing you know, we've got a huge sell-off in dollar yen. But guys, all we've done is come back up to this swing high right here in this level, and this was a classic bull trap here. That's what happened. Nice move back here on this crossover point, but then all of a sudden the market starts stalling out, coming back up, banging up against nothing more than what you can see is that I've got a swing high in here. Now this is what some traders will call, they will try and call this order flow. It's not order flow here, guys. Order flow is just a word that they've made up. What this is basically is you've got the market coming back to where it was prior to the Brexit, and the primary trend continuing, which was down prior to that Brexit vote. So right now, the key VantagePoint level to watch for next week, 104.63. As long as we're below 104.63, we are going lower. We have a trend line, very powerful trend line, however, coming in at about the 101 area, 101.10. Watch out on that area. If we're going to get a bounce, that's where it's going to be. However, here, guys, let me illustrate to everybody here so we understand what will cause a potential bounce here. So when I come to my VantagePoint portfolio here, I bring up my dollar yen pair. Then basically I'm not going to count on a specific indicator to tell me. I'm going to look at these intermarket correlations very, very closely. When I look at the global markets here, what forces the dollar yen up here is basically, in my respectful opinion, indisputable. Okay, the DAX moves higher, the dollar yen moves higher. Okay, we can see this all through here. You know, if the DAX sells off, the dollar yen pair sells off. So you can see how the DAX 30, the Nikkei, the S&P 500, they come into almost everything we trade. Even if you're not a Forex trader and you're watching this video, you should be trading your equities based off the Forex market, which is kind of funny, you know, and most people just ignore it. So the Nikkei right now, once again, discussing that trade, that Aussie-Japan trade, the fantastic trade, it was based around the fact that the Nikkei, VantagePoint is forecasting the Nikkei is going lower. When the Nikkei goes lower, the dollar yen goes lower. Money is going into the Nikkei or it is going into the yen. Bottom line here, I don't need to look at an Elliott wave to tell me that. I could care less about a Fibonacci number. It means nothing to me, guys. The intermarket correlation tells me money is going into one of two places, the yen or the Nikkei. It's not going into both. Bottom line, okay? That's the key thing to understand here. The Hang Seng, also a player here, is going to affect it, but the S&P predominantly, you can see that at times there can be a bit of a lag, but if the S&P 500 starts moving lower, and then basically the dollar yen is moving lower. So in my respectful opinion, the reason why the equities are unable to move higher this week, or more specifically the S&P 500, is because the Nikkei has it pinned. It can't move past it because the pressure on the other indices, specifically the Nikkei. So this is what you want to look at in your trading. And of course, the dollar index, guys, this is an indisputable intermarket correlation here. Okay, indisputable. We can see that basically as the dollar index starts to turn lower, it just drags the dollar yen down with it. That's what happens here, guys. Indisputable fact. I don't need to put 50 indicators on my screen. I don't need to be concerned about what a Fibonacci level is, an Elliott wave going to cause a problem here. None of that matters to me whatsoever. The intermarket correlations will trump them. And the other one here too is gold. When gold starts moving higher, that's a positive for the Japanese yen and a negative for the US dollar, which I showed at the beginning of the presentation. Very important that we look at this, because what we're doing here, what I'm doing here, is an outlook. By meaning an outlook, what that means is that essentially I'm telling you more or less what's going to happen. I don't care what's happened in the past, I'm saying what's going to happen. So I'm not looking back and saying, okay, well this happened back here and you could have made this amount of money if you did that. No, I'm not saying that. I'm saying as an outlook presentation, this is what's going to happen next week and why, and what's the key driving factor of these markets. That's what we need to know, the direct intermarket correlation. So when we see this, it becomes difficult to buy the dollar yen, even though most people will say, well, look how low it is. It's moved down 300 pips. We should get in there and start buying it right now. Well, I don't think that that's necessarily accurate at this particular time. I think we would be very, very cautious doing that because the intermarket correlations do not justify that at this particular time. So again, that critical vantage point level, which we really want to watch out for, 104.63. I'll leave it there, guys. But right now, the indicators from Vantage Point are really warning me here. The predicted MACD, the predicted RSI, the predicted differences, the fresh triple EMA cross. This tells me we are going to back down possibly to that 100 level within the next few trading sessions. So be mindful of that. Nothing's 100%, but it certainly does look like it's going to run into some pretty heavy selling. And August is a dead month here, guys, but it usually is a positive month for the yen. Now, as we come into our US-Canadian pair here, this has been an interesting one. We failed. Last week I talked about a move back to the 132 area. We got that, but we failed yet again going back into this April swing high. So we continue to see sellers up high and buyers down below. So when I zoom this in so everybody can see it, we can look at how we want to trade this next week. Now for next week, clearly we've got some sellers up here, but we also have falling oil prices. Oil can, even though oil was so low, I still put out a sell on it because that's what the software is saying. It's going lower. Well, oil did go lower. It went from 44 down to 41. That's a big move. So when I look at this right now, the key VantagePoint 18-day predicted EMA, that's the number we want to look at here, right? So we've closed below that, but on that GDP number, weak GDP number in the US means a weak GDP in Canada, guys. And what I mean by that is Canada's economy runs off the US economy. If it's a negative for the US, guys, it's a negative for Canada. End of the day, right? When we're going low, it looks like we're going to make a little bit more of a move down here. We've got trend line support at 129. I would anticipate we could take a run at this area, maybe even as low as 128.50. But then, guys, we want to start getting our longs back in there. I would not. There's very little reason at this particular time to be buying Canadian dollars other than some stronger commodities, but oil is the big one here. Okay, oil is the big one for the Canadian dollar, and if oil is going down, the Canadian dollar is going down, bottom line. So when I look at these intermarket correlations, we're still above the zero line on the predicted MACD. We haven't broken below this 40 level on the predicted RSI. Now again, I use that RSI different than most people. I'm using it to gauge momentum. A break of 60 is very bullish with a triple EMA cross. You can see, I'll just connect that here so everybody can see it. This is a fantastic signal. And a break of 40 is also a good signal. And here's the case in point right there, okay, on this one, on this break of 40 down here. Well, we don't have that, guys. We don't have a break of that 40. So this is not ultra bearish, not by a long shot. So keep that in mind. 130.64 this week is the line in the sand. If we can get above 130.64, stay above it, longs are back on the table. But if we come up, test this area, keep repeating, keep failing at 130.64, then we'll get our shorts in. But that's a very short-term trade, guys. 2, 3, 4 days. Okay, so remember what I said there. And then be very cautious down along this lower trend line around 128.50. Now, if we lose that area, then of course we are going to go lower down to the swing low, probably in the 128 area. But I don't think that that's necessarily going to be the case at this particular time, respecting the fact that we're coming out of summer driving season. Canadian economy very soft, very, very soft, especially under the new Liberal government. Doesn't stand a chance. It's going to be very touch and go for a little while. And if oil prices are down, that really, really hurts the Canadian economy. Now, when we come into our final two pairs, Aussie US, New Zealand US, these are driven by a couple of different things, but they are very similar trades to that US Canadian pair. So as long as US Canada is going down, guys, Aussie US is probably going higher. New Zealand US is going probably going higher. Now, we've got a fresh triple EMA cross, but again, we want to understand those key vantage point levels. Right now, 75.06, we've closed at 75.09. Buying down to 75.06 is a reasonable play as long as that area holds. We've got pretty firm trend line support coming in also. Right around this area, 74.50. Keep your stops below there if you're buying. But if you see those gold prices reversing and equities going higher, then chances are the dollar is going to strengthen yet again. So the Aussie is very much a risk on, risk off type of currency. So for now, we've got a change in the neural index, the predicted MACD. Now that position of that predicted MACD is certainly worthy of a look here. You'll notice how that the VantagePoint predicted MACD, the trigger is turning around and crossing the trigger back to the upside. And that position right there at 68.9 on the predicted RSI, where most people are looking to sell, I'm actually looking to buy. As long as I've got that momentum that we're pushing now, our trend line coming in just under 77, be careful around that area. And I'm going to draw everyone's attention to it right here. This upper trend line is a dangerous one, okay? So watch out up there. Buying up to that level is good, but to start the week, we've got three levels here: 75.39, 75.12, 75.06. These are your lower supports. So longs can be attempted down around 75.39, making sure your stops are below 74.50 with a slight bias of continued Aussie strength. Now, I think the same would apply next week for New Zealand. You can see that the two charts almost mirror each other. We've got a big push up here, and again, we just want to make sure we're identifying those key levels. 70.95, we've closed at 71.88. That's a very bullish close, even more bullish than the Aussie, but we are extending higher. Now, our neural index, we are coming out of oversold territory. We've got that fresh triple EMA cross from VantagePoint that with that key support level 70.95, looks like we are getting ready to move higher. The position of that predicted MACD, it's a good one, guys. It's a pretty good one. That tells me that we could be seeing even more strength here on the New Zealand currency. And once again, you can see when that predicted MACD trigger, VantagePoint trigger, crosses with a triple EMA cross, that can lead to a very, very substantial move to the upside. There's no guarantees here, but Aussie and New Zealand both like gold, so I think that both of them should be reasonable long trades next week, but always wait for a pullback. So once again, we've got a very, very choppy week ahead of us. We're in thin, illiquid summer trade. Things will really start to heat up again in September, but I think for now we still have some decent trading for next week.